right, welcome back, everybody. We are Money Mondays with the Disrupt Equity Boys, Ben Suttles, Ferris Musa.
We are here, Monday Mondays, every Monday, 3:30 Central. And where were we yesterday morning, Ben?
A little place called Iceland.
We were,
my friend.
But we had to cut it short and come back here just to be here with our audience.
Absolutely, absolutely. We love you guys. We want this to be an interactive show today. We were talking about how to quickly analyze multifamily properties. It's important stuff because the markets are shifting quickly. You need to understand, even if you're a passive investor, even if you're an LP, even if you're looking not to go buy your own deal, you just want to invest in somebody else's, some of this stuff's important. You need to understand how the numbers work, how they kind of flow through to returns, and ultimately how to be able to determine what's a good deal and what's a bad deal, right? You know, so we're going to get right into it because it's 3:30-ish and we're ready to rock. All right. How do you do a little quick and dirty, right? And I have my definition. I'm curious what yours is.
Yeah, so I mean, maybe first thing, right? Somebody says, I got a great deal, right? What are the first things you ask? I like to ask, what are the in-place rents?
Yep.
What rents you try to get to, and what's the purchase price?
Yep.
Those three things, I can narrow a lot of it down,
yep.
right? And so, you know, with that, you're ultimately trying to compare the ratio of what rents you can achieve with what rents, what price the thing costs,
yep.
and then, you know, in addition to that, where the deal is and what I need to spend to get the rents to where they need to go,
yeah.
right? Those really sums up a deal, right? It's, hey, the deal is making $1,500 a unit today. If I put $10,000 into it, I can get it to $1,800. If I'm at $1,800 and I'm buying the units for $200,000 a unit, probably works out.
$100,000 a unit?
$200,000.
Oh, yeah, okay.
$100,000 definitely works out.
I was about to say, that definitely works out.
Right, you know, and again, you're trying to get a feel. Now, for those of you from the residential side, there's the 1% rule, right? You want your monthly rents to be 1% of the value. So again, there's like a similar concept in apartments, right? Very rule of thumby, but it helps just help me understand if we're grounded, right? And, you know, are we close or not, right? Like today, actually, a deal came by my desk. Good deal. They're asking $250,000 a unit, but the in-place rents are only $1,300. Like, that's far.
That's
right.
Really
I don't
far.
know if that deal is going to work at all, right? Unless I can figure out a way to get to $1,800.
Yeah.
And so, you know, with that, you can quickly start to assess what's going on, right? And, you know, there's some other rules of thumb that we always talk about, right? 50% expense ratio, et cetera. And, you know, again, taxes can vary by market. We actually had an interview today on a deal, and that came up, right? Because in that market, we know that it's assessed a much lower amount.
Yep.
And so, you know, there's things like that that you could do if you want to start to get into the modeling part. But very high level, those are my questions that I like to ask. And from that, everything follows.
No, and I agree, right? You know, I mean, to kind of maybe even add on to it, right? So if somebody wants to sell it to you for $200,000 a door, and your rents right now are $1,000, and you're probably not going to be able to push them to, even if you try to push them to $1,500, maybe it works, maybe it doesn't. You really have to check it out. But I'm going to tell you right now, if they're at $1,000 and you have to put a lot of money in to get to them to $1,100, that deal's just not going to work. Don't even bother trying to underwrite it. It's just, regardless of what kind of debt you get and how you try to spin it, it just doesn't work, folks, right? Unless you just have some very, very aggressive reversion cap rates or some very aggressive, you know, other parts of your underwriting, right? But in a traditional sense, that's a good rule of thumb. As Ferris mentioned, typically on, you know, call it Class C, you know, it's probably going to be like 55%, you know, expense ratio, at least here in Texas. Right? So for those in other states, right, it might be a little bit different depending on your tax and your insurance situation. But here in Texas, it's typically 55% expense ratio, right? So what does that mean? That means if you have $1 million in income, right, your expenses roughly you're gonna pencil in at about $550,000, right? That is what that means. Right, so for a Class B, it's probably gonna be closer to 50%, and then for Class A, it's probably gonna be like 45.
Yep.
You know, and then here in Texas, the insurance makes up what 20-30% of that number.
Yes. So then maybe that's a good segue, right? So, you know, we're talking about very high level, not numbers on paper. But now, let's say you are digging into numbers, right? What rules of thumbs do we have? We have, you know, in certain markets, like we know a payroll on a C-class asset, we could probably get it down to $1,250 on the lowest side of it, right? A unit. On an A-class asset, probably closer to $1,450, right? So again, that's a rule of thumb. So if I see a deal and their payroll is $1,600, there's some runway right there to cut expenses.
But why is that, right? You know, like you have to take a step back, folks. People don't get so bought up into the numbers that you're not saying, like, why is he saying that a Class A deal is going to have higher payroll, right? I'd say because you're going to have a little bit more affluent
You
part.
have some people like Ben living at the property who's a little bougie, right? He wants a higher level of service. And so, with that, people expect things to be repaired quickly. People expect people to, respond to them, be available. Yeah. People expect someone just really to kind of be a concierge, right? I actually toured an A-class property, and one of the value adds is that they didn't have a concierge, and that's what they add in. God
forbid. You don't have concierge in these days? No. So that doesn't mean that the A-class payroll or the A-class people working at the A-class deal are any better than the people that are working at the scene. Yeah. I think they're all great on our team, right? But the point is that you just sometimes have to have that extra polish, that extra oomph, because they do expect you to almost, cater to their every whim, right? So just take that into consideration, right?
And so that's just one, right? Payroll's an easy one to pick on, but again, like Ben said, we have a whole list of these types of things to think about, right? Taxes, similarly, right? We kind of have a very rule of thumb. Okay, if I'm buying it for this, we figure out what the assessment is and what the tax rate, millage rate is, and then 90%. Very rule of thumb. Then we dig in, okay, do we know this county? Do we not, right? Different counties do different things. Payroll, what other big ones are we talking about? G&A, admin, marketing, right? All of those things have general rules of thumb. Yes. And there's a company called, I forget the name of the company that provides actually very specific markets, general rule of thumbs. It's a booklet.
It's IRM.
IRM. Yes, it is IRM.
Yep.
IRM, go search them, right? They publish, hey, in Tampa, here are the average rule of thumbs that we saw for G&A, payroll, et cetera, right? And so go understand that data. Go get to know it. That can quickly help you understand what is an outlier with the current deal from the current seller, and is that something that you can then trim, right? And again, these are rule of thumbs, and so you still need to apply logic and reason to these things, right? Is it realistic or not? Because maybe you say, hey, the current seller payroll is $2,000 a unit. You're like, great, I can get that down $600.
Yeah, don't just.
But maybe not. Maybe because you realize it's a nursing home and they need full-time nurses on staff. Like that doesn't make sense. Yeah. So again, apply logic to the reasoning.
No, for sure, right? It's all common sense, folks. So he brought up an extreme example, but that's actually a pretty good one just to make it real simplified for everyone.
I'm actually impressed I thought of that on the fly. I was thinking about what it is.
That's not bad. But hey, a couple things that we do also, right? So we've got some tools with some partners that we've worked with, right? So Strategic Insurance Group is one of them. They allow us to get in there. We pop in a couple data points. Boom, it spits out our insurance number. That is really crucial in these days right now because insurance is creeping up, unfortunately. And so you need to dial that number in. Also, Peak Financing has a great tool on what you can think or what you can expect in terms of loan terms. And I think that's an incredible product too, right? So check both those companies out, Strategic Insurance Group and Peak Financing. I think that those are going to help you guys underwrite to some of those unknowns that people really don't know, and they're just kind of doing this thumb in the air stuff, right? You need to start systematizing your whole entire process, right? Which kind of segues into one of our last questions here is, what does our process look like, right? Now we're not going to give away all of our secret sauce, but it's a multi-step process to when we submit an offer, we have done a fair amount of due diligence on that deal. And we explain all of this to the brokers who are just blown away that the amount of steps and the amount of people that are involved, right? And then ultimately it could always be better. It could be a little bit more systematized. But for right now, I feel really, really good about what we're seeing. Because at the end of the day, we're underwriting, 30, 40 deals a week?
Yes, sir.
So, we have a lot of good data points on where expenses are supposed to be. But mainly what it is, right? Just if you want to mimic it, that's fine, right? We've got a VA team that are doing a lot of the data entry. Then we have stateside analysis or analysts that are doing a lot of kind of the assumptions and, okay, where can we potentially really push rents, right? And then it ultimately bubbles up to the leadership team, right? We have 2 deal syncs a week. We take this stuff seriously. This is the blood that courses through Disrupt Equity, right? And you need to, you can't just be like, oh, I'm going to, make an offer this week, or I'm going to underwrite a deal this week. That was what I was looking for.
I was trying to remember. Bloodbath, no.
I'm tired, I'm jet lagged.
Bloodline, it's our blood.
Give me a break, I'm jet lagged. But, point being is we've taken this a lot more seriously, especially over the last 18 months, and turned it into a full-blown process. And if you want to look at the amount of deals that we're looking at, you have to do the same thing, folks, right? And so again, rules of thumb are helpful. Working with great partners that already have tooling that will allow you to get good data points is really, really helpful. And then ultimately underwriting more deals. It's a repetitive thing. It's just like tying your shoe or riding a bike. You have to get back on there and remember how to do it. And once you've done it after so many times, it becomes very, very easy to underwrite deals, right? All right, I'm moving fast because I got some coffee running through me.
And really quick, Mondays, every Monday, 3:30 Central. If you have comments, questions, go ahead and leave them. We did get a lot of comments, questions come through. So if you have one, please leave it so we can get to yours before we run out of time. But let's keep going.
Any good ones?
Let's answer a few. So Omar says, in hot markets like Austin, how do you justify the 1% rule? Right? You don't really justify it. That's part of it, right? Yeah. You're looking for something with cash, some sort of yield, right? That's what we look for. We're buying a deal in Austin. It's got a yield component, and then you're really looking at the appreciation play as well, right? And so we know the thing about a hot market is for every dollar of NOI that I get added to the bottom line, it actually increases the value more, right? Because if it's a 4-cap market versus a 5-cap market, right, that dollar is actually worth a lot more. Yeah. And so that's where you start to play, you play the cash flow game, but also you get depreciation. And depreciation doesn't mean that the 4-cap market became a 2-cap market. It means that for every NOI dollar I put in there, it juiced the whole returns, right? The whole value of the property.
Yeah, and you got to take some of this into consideration too, right? I know at the end of the day, Austin is a little bit more of a high appreciation market versus a cash flow market. But we like to kind of blend things together depending on where we're looking at. And I think that in some cases that's good to have in your portfolio. Let's be honest, Austin is probably the best example of just having a ton of great news behind it. It seems like every other month there seems to be a major corporation that's moving in around Austin, or they're building some kind of a multi-billion-dollar plant, or they're buying up land to build something. It's the most incredible growth story I've seen in a long time. And obviously I lived in Texas. Texas has got growth across the board. Austin's the juggernaut. So, anyway.
All right, let's answer a few more really quick. Let's see. So, Gloria asks, when doing a preliminary underwriting on a property, what numbers/elements are you focused on? Also, are there any markets that you are seeking to invest that is not considered a hot market?
So, let's take the first one. I'm not quite sure if I understand that question, though. How would you interpret that?
Ultimately, what are we focused on? We're focused on effective rents, projected rents, and price of door. That's what I think we kind of answer that.
I guess if we're talking all the way upstream of the deal, those are probably the most important things to really focus on.
And then preliminary, going in cap and then exit cap. So that's probably another big one.
And really you have your column here that has the T12 expenses, and then what you could do is you have your rules of thumb, right? And there's mechanisms within Excel that can highlight things that are off. Right, and then that would be an instance where you might want to dig into those, right? Because again, you should be looking at a lot of deals. You're not going to be able to go line by line, GL code by GL code, and figure all this stuff out, right? But I would say the one thing that, and this is also owning a property management company, it is a lot easier to push revenue than it is to squeeze the juice on the expenses. Now, there's always going to be some obvious stuff, so I always encourage people to continue to look. But if you can put the money in and you can increase the rents, your return on your investment is going to be a lot better. Trust me, it works out every single time. So, what return metrics must a deal hit for it to move forward in your acquisition pipeline? So I think right now it is a hot market, right? We're looking at 7 to 9% cash on cash. Yeah. Probably 13 to 16% IRR depending on the deal. New development's obviously a little bit higher. We do invest in those as well. But that's just because there's just a little bit more risk involved, right? But that's just a rule of thumb, right? There's different plays, there's different deals, there's different markets. Going back to that other question too, right? Is there other markets that we like that are not considered hot? I guess there's always secondary markets within the states that we invest in.
We were just in one that's not a hot market, Iceland.
Iceland.
It's a bad joke. It's cold. It's very cold.
It's very, very cold. And actually, I think the real estate market is actually pretty hot there, from what they're telling us. But no, I think look in the secondary markets in some of these states, right? We love Texas, we love Georgia, we love Florida.
Yeah, the most money we ever made was in Beaumont, Texas.
Yeah, come on, Beaumont, that's 90 miles east of Houston. It's a secondary
as we've grown, there's also a lot of benefits to being in primary markets. And so again, and there's a lot of them, right? Is Boise a hot market? Yeah, it's a hot market. Is it a primary market? No. Right. And so I guess it's maybe the question of, are you asking about primaries or are you talking about hot? Because they're two different things.
Yeah, that's true. That's actually very, very true, right? Mm-hmm. And I'd say across the board it's hot. So I know hey, let's go try to find some easier deals. I'd say in those smaller markets you're not going to have as many people bidding on it, but it's still going to be competitive because a lot of people are just chasing yield all over the place, right? We went through, do you apply Z rules of thumb? Yes, of course we do. Key factors that kill a deal. I think right off the bat, that Ferris brought up the best one, right? If they're asking $200 a door and rents are $1,000, right there, we don't even bother underwriting it, right? It's already overpriced. I wouldn't say that there's anything else that like stands out as a deal killer piece of data or metric. But it's certainly, if it doesn't fit within our buy box, we're not going to buy it. And I've talked about this many times in the show, folks. You need to determine what markets you want to be in. You can't be shotgunning all over the country. It just doesn't work. You're not going to get enough economies of scale doing that. And it's going to be too hard for you to keep up with all the broker relationships that you need to be building, right? So if somebody sends me a, Class A plus new build in Manhattan, guess what? That's not our buy box. We're not buying that. So that's going to kill a deal pretty quick. One of the other questions that had come in before the show, what are cap rate assumptions that we're kind of underwriting? Again, I've gone through this on multiple shows, but typically you're going to have a kind of a stabilized in-place cap rate right now. Let's call it 4.5. You're in the deal for 5 years, right? You're typically going to do 10 to 15, sometimes 20, just depending on where it is, basis point increase each year that you're holding onto the deal. Now, this is not some magic formula or something I came up with. It's always kind of been industry standard just to be conservative. But I've also seen it go 300 basis points lower in the last 7 years that I've been in the business too. So, in every single, property that I've had, we've been in the money, right? But you just don't know where interest rates are going to go. So just be conservative. So if you're buying at a 4.5 cap, you're owning it for 5 years. Let's just use 10%, increase, or 10 basis point increase. You're going to be selling it at a 5 cap, right? All right, that's right. I think that's
right.
All right, good. All right, what leverage assumptions? All right, so let's talk about debt. Oh, go ahead.
No, keep going. I was answering some questions, but let's go ahead and keep going.
All right, so leverage assumptions, or let's just call it debt assumptions, right? So I think one thing that I want to point out, because we're talking about underwriting, this is so important. So reach out to Peak Finance and go to their tool. They got a lot of great information there. That's really going to be kind of the real test of where the market's at, currently. But what we're seeing is leverage is coming down, folks. Interest rates are going up. They're tied to each other. The higher the interest rate goes up, the lower the leverage you're going to get, right? The lenders, everybody's kind of in this discovery mode. They don't know where interest rates or how high they might go, but the Fed continues to talk very hawkish. What does that mean? That means that they are going to increase rates, right? And what does that mean right now? That means rates are going up. So, whatever you were doing before, you should be increasing it by 50 to 75 basis points immediately. Now, also on your refinance, you're probably going to need to increase it by 50 to 75 basis points as well. Now you're going to say, well, what if they come back down? Well, Ben doesn't have his crystal ball. If he did, he'd be, a millionaire at this point, right? So at the end of the day, it's always better, just like with the reversion cap rate, to be a little bit more conservative. And then just, if that ends up being in your favor, maybe it goes back down to 3, guess what? You just made a fortune. So those are some of our quick and dirty underwriting, processes and assumptions, but let's get into some questions.
Yeah, so Money Mondays is every Monday, 3:30 Central. If you have comments, questions, please leave them, and we will go answer them live. So let's see. So people asked for some links to the insurance and the financing tool, so those we already gave those out.
So Shannon, can you dump those in the channel?
It's already in there.
Okay, cool.
Let's keep going. Vlad asked, what's the website? How do you spell the 5 rules of thumb info? I looked it up. It's IREM.org.
Yeah, and they're like actually .org.
Yeah,
right?
There's a publication they have. It's like a booklet that you can buy. I'm guessing there's a digital version.
It's a little pricey, but it's current. It kind of aggregates data. I'm sure RealPage has some stuff too that you can buy into. All this stuff's very, very expensive though, folks. So just realize that if you're going to go down that route, even an IREM booklet, I think it's like $2,000, but well worth it, right? Because you don't want to always constantly be figuring out what's the payroll number in Florida. Who knows, right? You're going to either have to know that market really, really well, work with a current property management company out there, which you're probably going to burn out because you're going to be asking them 1,000 questions, or you got to go buy data that is accurate that you can use for your rules of thumb.
All right, let's keep going. Next question. Any courses or resources that you recommend for learning multifamily underwriting? We do have a bunch of courses that we spent a lot of time putting together on investoracademy.net.
Oh,
so
yeah.
definitely check it out.
Yeah, check that out. And we'll drop a free coupon code in there if you would, Shanna. But yeah, got a lot of that. There's a lot of great information out there too, folks. That's what I loved about it. When I first started off 10 years ago, getting into real estate, there wasn't as much information online There's a ton of information online. So check it out. There's a lot of great places. There's a lot of good spreadsheets out there. We've taken one and we've hacked the hell out of it and, added all kinds of crazy features because we've got some pretty, sweet, spreadsheet wizards here at Disrupt Equity. But you can do it, and as long as you're looking at the numbers and the numbers are accurate and your formulas are good, I've seen people just, create their own too. Yeah. So.
Perfect. Let's keep going. So Amanda Larson asks, do you have any rules of thumb for CapEx? Yeah, we do. It really depends on the asset, but maybe the simplest way to think about it is for about 8 to 10K, you can get a lot done on the interior of units. So if you're doing interior upgrades to get kind of decked out, you want to be at about 8 a unit.
Yeah.
Average, right? That's kind of what it's going to cost today. And then you figure out what you're doing on the exterior.
And I agree. And one thing and we've talked about this too, Amanda, in the past, right? The stuff is going up. Appliances are going up, flooring's going up, labor's going up. So those interior upgrades, I know back in the day we were all underwriting $5,000 a unit. That's not the case anymore. It's 7 minimum. I'd say it's probably 8 to 9, right? And so remember, that's interior units. On the exterior, it's going to be anything in between. So just take that into consideration, right? But typically we chase deals that have 5,000 to 10,000 a unit cumulatively, right? And CapEx that's needed. Right, but you could be a deep value add gal, or you could say, hey, I'm going to chase something that's a little bit cleaner. I don't need that much, But ultimately, I think Dax actually with Heritage, he's got a cool tool.
He's got a tool to help.
So maybe we'll try to drop that in. It might be after the fact. I don't think we have that off the top of our head, but he's a great guy, and he's got a tool that can kind of help you with CapEx too. He did actually a webinar for us last year about it. So
And one last question, and we'll keep going.
Right.
How have you adapted your current underwriting to address the rapid rise in interest rates / appraisal values for properties?
Yeah, we were just talking about that, right? I think you have to realize that is happening. And you're going to have to move your interest rate assumptions up by 50 to 75 basis points immediately. And so is that going to obviously, kill a few deals? It absolutely is killing some deals. But you need to be smart, and I would also say you need to be backing off of your leverage, right? The bridge lenders are still out there. They're still hungry, but they're being a lot more picky. They got real busy last year, and now they're cherry picking deals. So you're not going to just be able to throw a dart at 20 different names and everybody's going to throw you 80% LTC, right? So just realize that your leverage is probably going to come down in the meantime, both on your bridge loan as well as on a refinance, right? So you should really be underwriting to 70, 75% tops at this point. Boom.
Let's keep going.
We got through that. I love it. All right. So this last weekend I was at Secret X with this guy and it was amazing. But one of the guys that was there, his name's Eric Upchurch. He's doing some great things to help out homeless veterans. So check out Veterans Community Project. And if we could dump this up there we go. All right, so we're donating homes to homeless veterans, right? They're out there, they're building homes currently. We're looking to raise some money for them. This is a passion project of ours. We have our own charity as well. We love this type of stuff. We're always trying to give back. I'm trying to raise $30,000. So give me 15, I'm gonna match at 15, folks. Right, we raised a little bit of money over the weekend. I think Eric said that we got I was convincing people over drinks, hey, put money in. I think I was able to get about 10,000 for them, along the way, which was always great. But I wanna raise more because this is a problem that we have and we need to take care of those who took care of us, right? So check it out, bit.ly/donate to homes for the brave. Check it out. Even if you could put $5 or $10 in there, that'd be a big, big contribution. We appreciate it. All right. MFin, baby.
All right.
We got a date. Oh my gosh.
We got it.
We got
Seattle,
a date.
July 23rd. We are all set, people. So we look
I thought we were going to Seattle.
No more. Seattle's before we announced it.
All right, we're going to Seattle, folks. And who doesn't want to go to Seattle in July? If you haven't been up there in July, that's probably like the best time of the year to go.
Best time of the year. We're definitely going to do some plans to stick around. So.
Yeah, so July 23rd, 2022, Seattle, Washington. Early bird. Oh my gosh, $150 off. Put that coupon code in there. It runs through April 21st. Website is mfinvestornetwork.com. Register, get registered. We do expect it to sell out like the last one. We've got a lot of great speakers and panelists that we're rolling out over the next couple of weeks. You'll be hearing about those. So please come hang out with us. It's a day long. We do some networking Friday. We have the event on Saturday. We do some more networking on Saturday night. Everybody goes home Sunday.
It's one day, awesome event, and it's going to sell out, and prices will continue to go up. So if you're interested, definitely book sooner than later.
Love it, love it. Look forward to seeing you there. What's coming up next week? Our apartment investing strategy. Oh my gosh, we're giving away the farm again.
Yeah,
Shanna, you're killing me. Just joking. No, we're excited. Check it out next week. What time do we do this?
3:30 Central every Monday, except for next week. We have a big meeting coming up, so probably the week after.
Oh my gosh.
We'll push it to the following week, so we look forward to seeing you guys all there.
All right, cool. See you then.
Thank you.